Another big story today, the Fed's favorite inflation gauge, PCE, out this morning, ticking up about 0.4% month over month. But for year over year core PCE, that cooled to its lowest level that we've seen since 2021, coming in at 3.7%, in line with the street's expectations. This is a positive trend for Fed officials heading into the November 1st interest rate decision meeting. We want to bring in Jeffrey Sherman, DoubleLine Deputy Chief Investment Officer. Jeffrey, it's great to see you here. So we're seeing a bit of a muted reaction here in the broader market on the heels of this inflation print that we got this morning. Do you think that it's enough here just to reinforce that the Fed should stand pat and not raise rates again at this next meeting?
Yeah, I think that's what it's really in line with the consensus, and that's kind of why you see a somewhat muted reaction in the marketplace today. Again, we're still in pre-market. Bonds are trading. They're a little off in yields, or slightly higher today, but this is pretty much a consensus report. What you find is you noted the headline number there, and that's really being driven by commodity prices. We've seen the change in oil over the last month or so. And so effectively, when you dig into like the core side, you look at the services, they are starting to decline, but really not as fast as the Fed would like. But it doesn't mean that they should continue to hike rates at this point. As we heard from Jay Powell at the last press conference, he's already saying that policy is tight today. And so a tight policy doesn't mean that we need to continue to hike at this point. You've seen deceleration year over year, both in the CPI measure as well as the PCE, which is their preferred measure. And so I think this is a welcome trend. I think that's what's really kind of calmed the market somewhat today, as we've had a lot of volatility in rates over the last 2 months. And so I think this is being welcomed on both the equity as well as the bond market today.
Jeffrey, what kind of messaging are you looking for from the Fed when it meets next week? What are you bracing for? What are you preparing for?
Yeah, Diane. Well, I think really the thing to look at is to kind of get what the signal is for the forward-looking policy. And the bond market really doesn't have another hike priced in. I know in the last statement of economic projections that we got back in September, that there was this dot plot that said on average, or at least more Fed governors expect another rate hike than don't. But I think now that we're seeing this kind of trend in inflation, I think the right messaging is to pause at this stage. We know that interest rates take a while to get into the broad-based economy, and I really feel like we're just finally starting to see some of the impact of these tighter policies. And so when I look at the report too on PCE, there's a little disconcerting behavior in here. If you continue to look at this all year, we've seen an increase in spending that outstrips the increase in earnings on the income side. So this just means that there's effectively a draw on savings out there. And I know this has been something that the Fed is focused on, a lot of Wall Street is focused on, is this concept of excess savings in the marketplace. And so it seems that the consumer, although spending and looks very healthy, it's done so at an income growth rate that's not keeping pace with that consumption. And so, again, I think this is consistent with, commodity prices being up. When you ask the average person in the U.S., what's the inflation measure, they judge it by two things: their grocery bill or their dining bill, the food consumption, and how much it costs to fill their tank at the pump. And so I think that some of that increased spending we're seeing is coming on that side right now. And I know there's a lot of uncertainty about the geopolitical risk out there and what this ultimately means for the energy markets. And so I think the Fed needs to be patient. The Fed hiking rates can't curtail price movements and the small wiggles and jiggles we get inside of the oil prices out there. But I think if they look at the overall economy, I think it is indeed kind of slowing down to some of the metrics they're looking for. And effectively, I think that is rife for them to be able to continue to have this paused behavior. So we at DoubleLine really think that the Fed is close to the end of the hiking cycle. And really, if they hike one more time or not, the market is even less than a coin flip at this point. And it says not at the meeting next week, nor at the meeting in December at this point in time. And so I think the data corroborates that the Fed should continue to hold. And I think that the policy is tight, and we just need to wait for these effects to really slow down pieces of the economy.
So, Jeffrey, given all those uncertainties right now that you just mentioned, the rise in geopolitical risk, what that could mean for the oil market, we also have some worrisome signs that's coming out here from the consumer just in terms of their spending patterns. And we also have this massive run up that we've seen in rates. So I guess my question is, if you think it's enough here for the Fed to stay on the sidelines, at least for now, what's the probability, though, of a recession given some of the worrisome signs that we're already seeing before, or whether or not, I guess, regardless of whether or not the Fed is going to hike again?
Yeah, I mean the recession, the probability of recession is not zero at this point. I know we're all going to celebrate the GDP report from yesterday, but I like to remind everyone that that data is backward looking. We've seen the bulk of that data that got that led into that report. We saw that throughout the last month or so, and so effectively that's a backward looking measure. And so when you talk about the consumer spending and income is not keeping pace with that spending, it is a bit worrisome. But it doesn't mean that we tip over into recession instantaneously. And so the pent up interest rate moves that we've seen over the last 19 months or so, as the Fed's hiked 525 basis points, that is starting to finally bleed into the overall economy. And we have a lot of fixed rate debt out there. And what I mean by that is, like, think about a mortgage. It's a 30-year fixed rate. Look at corporate America that did a massive debt refinance, a debt binge in 20 and 21. And so effectively, those parts of the market aren't as impacted by the interest rate hikes because that debt has already been structured out. It has a long tenor on it. But effectively, what you find is that if you're in the market now, you need to secure a mortgage. Mortgage rates are 8%. This is much more challenging, especially how high prices are in the housing market in general. And so we've seen an uptick in delinquencies. We've seen this in kind of the lower FICO cohorts, right? The lower credit qualities, we usually call it subprime. But in the auto side, we see it in some parts of the mortgage market that you're seeing signs that there are people late on payments and starting to miss more payments. And so I think this is part of engineering the hiking cycle. Capital is tighter, it's tighter financial conditions. And so what this does is this increases the probability. And so we still think that a recession is more likely in the next 12 months than not. But effectively, we're going to have to wait and see if this resilience of the consumer continues. And really all signs when it comes to a recession is what is going on in the labor market. And so all eyes will be on next Friday's jobs report to see what this activity looks like now that we have these tighter policies out there. And effectively, can the labor market prevail? Because we know a recession starts when the job losses really trickle through the economy. And so unfortunately, that's a bit late. That's usually a sign that you're already in the recession. But thus far, the labor market has been resilient. And so you got to keep watching. You got to watch small and medium businesses. That's where a lot of the job creation has been. And these are the businesses that borrow at floating rates, right? They're tied to prime rates. They're tied to bank loans, and they borrow from these small and community banks. And so those are the areas to watch for forthcoming weakness to see if this labor market is going to continue its resiliency.
And Jeffrey, I just want to quickly ask you something about, we've been really following the pattern with regard to yields. Have we seen peak yields?
Well, it feels like we're very close. If not, we've seen it. The 10-year has kind of tested this 5% level, and we saw it Monday in overnight trading in Europe. Then kind of when New York opened, we were like 501 on the 10-year, and it just really rallied from there. And so we pressed a bit higher intra-week. We didn't really get there. And so I think most people out there are calling somewhere between a 5 to 5.5% 10-year as being the peak. I think 5.5 seems a little rich. That we would actually get there, or too cheap in the market in terms of buying. And so far, I think it's a pretty good sign that we haven't really breached that 5% on a closing level on the 10-year. So again, the Treasury market, irrespective if we go to 5.5%, we sit at like the 487 or something we're at this morning. Effectively, it's a yield that outstrips inflation, right? So you have positive real yields out there. And so for investors that have been looking for yield in the marketplace, you have none other than the high quality asset of the U.S. Treasury market that generates a positive real yield that is one above inflation. And so investors have been looking for this for many years. And so you can put this together with a bit of a credit portfolio. It's pretty easy to put high quality portfolios together that yield like 7%. So even if interest rates push up another 0.5% or so, you still have a yield that will offset any price movements there. So from an investment standpoint, bonds are looking extremely attractive today. And if you're a risk taker, you can just delve down in credit. You can go lower credit quality and get 9 and 10% today. That sounds like an equity-like return for a calendar year. And so I think what's going to happen as we get later into the year, people are going to reassess this as they position portfolios for 2024. And they're going to really look at what's going on in the market and see that there's a much more stable return profile in the bond market. And all this carnage we've seen has just set up a really good opportunity for the next couple of years in the fixed income markets.
Well, you've certainly got me thinking. All right. Our thanks to Jeffrey Sherman, DoubleLine Deputy Chief Investment Officer.